That's a pretty good indicator of impending trouble when people's confidence in the following year is so lousy. And it's unusual. And it has seldom been this bad. History will say that the 21st century is unusual, abnormal, aberrant even. The window from 2000 until now has been abnormally high profit margins, abnormally high PEs, abnormally low interest rates, etc. 40 years of lower and lower interest rates push asset prices up, particularly housing, through the mortgage mechanism. How can it not? If you can afford to pay more for your house because the mortgage rates are 3%, sooner or later you pay more for it. And so the competition bids the price up to fill the available affordability. Now the mortgages are 7. The same will happen in reverse. Doesn't happen overnight. Everyone in the market wants everything to happen yesterday. But with interest rates and mortgages, it can take a long time to percolate through. But you can be absolutely certain that it will. If the world were to behave like it has behaved in every other major bubble, that's all it would take.
Are we in a major bubble?
Yeah, of course. If you look at a 10-year smoothed average PE and a Schiller PE, you find that there's a pretty decent spike in 1929, a much higher spike than that in 2000, and a slightly lower spike than that now. This is approximately the second highest point, higher than 29. And in each case, they back and fill, and they go back to more average levels, even if you allow for a moderate increase in the normal Schiller. We know the market doesn't like inflation. Let's find other things that the market likes or doesn't like. And let's explain on a coincident basis why the market sells high and low. It turns out the market is a coincident indicator of comfort. What makes the typical portfolio manager feel comfortable? And number one, it loves low inflation.
Yep.
It hates high inflation. It likes 2% stable inflation. It does not like to see it bouncing around. It doesn't like to see it spike in the worst way. And it does not like to see it hanging around for multiple years. That's the most important one. Secondly, it loves high profit margins. What a surprise. Now, way down in third place is the stability of growth. The growth rate does not have a positive correlation with PE. The market is nervous about bursts of high growth. It doesn't like +9, -2. It would rather have +3, +3, +3 than +9, -2, even though it averages high. It likes certainty, stability. Yeah. Comfort is the best description. So you look at this model, and it says 1929 should not have been a surprise. It had low inflation, high profit margins, wonderful profit margins, incidentally. And the growth rate was ticking along at a pretty high rate, and it was stable. So heaven. The market called the Great Depression. Everything was bad. It got the Nifty 50 right on the nose. It got the idea in the 70s that you'd be 7 times earnings because terrible inflation, persistent terrible inflation, low margins, wild economic growth. Yeah. So at 6.8 times earnings was the trough, and the model called for almost exactly that. So then it makes what you might call a major error for the first time in 2000. It says in 2000, wonderful profit margins, no inflation, you'll have the highest PE that you have ever seen. Not bad directionally. Instead of 21 times in 1929, a new peak of 25 times. And it goes to 35 times. And that was not explained by anything we could see in history or then. It just happened. You could argue that that is the only really crazy psychological event up until then in American history. We got it 18 months later, it's back on trend. We got the setback, we got the housing bubble right, we got the wipeout right, and then it brings us to the second major deviation. Second major deviation starts in the second half of 21. Second half of 21, we have an inflation spike. Every time we've had an inflation spike in history, PEs have gone down, sometimes rapidly. This one was a strong inflation spike, bloody PEs went up, creating a major gap where the model goes down and the market goes up. And suddenly we've got a big gap. Then the market says, after all, I'm not sure I believe the Fed. And the beginning of 22 is the worst 6 months since 1939. But the model is still going down because inflation is hanging around and the model declines. So fast forward, what does it say today? It doesn't like the pattern of stickiness in the inflation. It doesn't like the profit margins, which in real terms have been coming down quite steadily now for over a year. They're down over 15% adjusted for inflation. And the model calls for 16.8, which in the long term is still pretty high. but the actual market is 29.
Times earnings.
Yes, on a Shiller, smooth basis. And on a Shiller, it's 29. This is a pretty handsome gap. And what this says is that is if the market responds to the same forces that it responded to over an entire 100-year period. It's only been different for a couple of years since inflation spiked. Do we really feel the market is cool about inflation, that it will not get a moment of second thoughts like it had at the beginning of 2022? Maybe this is not going to be as neat. Just back up a few weeks and we reached this kind of honeymoon period once again, where everyone was confident we were going to have soft landing. Now, 1929, 2000, 1974, the Nifty 50, every one of these we were going to have a soft landing. Trust me, check the data. Everything was going to work out fine. It never does. If you want to look at the great bubbles and nothing but the great bubbles, what you find is the most interesting distinction is one that is unique to them and nothing else. It never happens any other time. And that is the leadership of the market going up, 70, 80% in a year starts to go down as the blue chips continue up. Now, the ones going down have a beta of 1.5. They're meant to go up 50% more than the market. They can't even get the sign right. So in 1929, the S&P was kind enough to have a low-priced index, which was pure junk. Pure junk had been up 80% plus in 1928 and is dropping all the way through 1929. The day before the crash, it's down almost 40% before the crash. It is the great, I like to say, primal scream from the stock market, ever, up until then. Nothing like that happens again until 1972. In 1972, the S&P is up 17. The average big board stock is down 17. That's not bad. Then nothing like that happens again until 2000. In 2000, we know what happened. They take out the growth stocks and they go down basically 50% before rallying, and the rest of the S&P goes up.
Yeah.
So in September, the S&P is the same as it was at the peak in March of 2000.
Right.
In the meantime, the growth stocks have gone down 50%.
NASDAQ has gone down huge.
So the rest of the S&P, ex the super growth stocks, has gone up about, we calculate, 13, 14, 15%. Same thing has happened. High beta stocks have gone down, blue chips continue up. And it happened this time too, only the fourth time in history where going back to 2021, starting with QuantumScape and quickly going through Kathy Wood's portfolio and on through the meme stocks and everything. There is an ugly year following my waiting for the last dance. Because lasted right through the end of December. But that is exactly what it did in the other three bubbles. In other words, if you're predicting a bubble, you should be saying, and the characteristic of this decline will be this unique, odd event where the super leaders with the highest betas go down as the last gasp of the blue chips. And then the bubble will break. I think the temptation to manipulate these major variables is overwhelming, particularly done in the interest of saying the market can go up a lot. I have a long history of dealing with this tendency over a few decades, and I get it. It's nice to be optimistic. And given half a chance, the investment business, of course, has a commercial imperative. It absolutely has to be bullish. It doesn't make any sense to be anything else. It maximizes their return over the full cycle, and that's how they do it every time they're bullish. So you never expect a major investment house to be bearish. They are risk factors. Price to book is the market's definition of who's got the most suspicious assets in the business. And small cap are more likely to go out of business, of course, than large cap. So when you buy them, you take on some risk and you expect a higher return.